This is Pre-Market Prep. I'm Brianna Valesky here with Joel Elconin. We have Jack Litle on the line. He's from Mercenary Trader. Jack's got 17 plus years of experience in the market. He cut his teeth at an international commodity broker with clients on 5 continents, including a large Russian hedge fund, and has traded virtually every asset class except real estate. His specialty is global macro. Jack, thanks so much for joining us. How are you doing this morning?
I'm great. Hope you guys are great too.
Absolutely. So we've had a lot of bubble talk lately. Carl Icahn was on CNBC yesterday saying he's expecting a pullback in the stock market. Other economists has said similar things. But you think that the Silicon Valley tech bubble, something that Mark Cuban harps on a lot, is a red herring compared to global real estate. Can you expand on that a little bit?
Sure. I think a lot of people are debating whether or not tech is in a bubble or not, and I think that's sort of the wrong question. People who defend tech valuations point out that only a very tiny class of companies like Uber and Airbnb and so on are the ones with huge outsized valuations in the 25 to $40 billion range. Snapchat 15 billion, but these are a few small concentrated winners. And there's a long tail of tech that is just not overvalued. And so Mark Andreessen and these other guys can make a legitimate case that tech is not in a bubble. It's just these private companies are actually doing world-changing stuff. And I think they actually have a point. So if someone argued to me tech is not in a bubble, I would say you do have a good point. But then I would say when you look at global real estate and you see that there is a spec property in Beverly Hills that's going to be going on the market at $500 million, or you look at Hong Kong and you see that they have properties, apartments that are going for $500,000 that are the size of a U.S. parking space. You can see that there is a huge global bubble in real estate, and that's actually much more dangerous and interesting and indicative of problems that are going on right now with monetary policy.
What do you think that indicates regarding monetary policy?
Well, I think a couple things. I think central bankers have become very arrogant, particularly at the Federal Reserve, because things have gone the way they wanted it to over the past 5 or 6 years. And they've said, oh, our policies aren't causing inflation, there's no distortion. But actually, there's huge distortion. It's just in a couple asset classes that, that people aren't talking about front and center. And so I think it shows that we've got a lot of really weird, distorted things going on in the system, and it's going to be negative and it's going to end badly. And it's also really impacting people in ways they don't realize. And so here's an example. We have some colleagues in our London office, and they're telling us how you've got these sort of wealth ghettos in the middle of London where, these international buyers are just buying up all this real estate, and then that pushes everybody out in waves. The people who normally would have lived there live a little bit farther out and a little bit farther out. And so then you have the middle-class guy trying to get a job, and he has to literally live 100 or 150 miles out of the city or something crazy. Wow. Because it has an impact. So all this stuff has an impact that people aren't talking about and people don't see, and it transfers down to the normal person. And central banks just don't admit that at all. And that's going to come back and bite us in a big way.
Speaking of monetary policy, everyone's talking about Greece right now. I mean, the last update I saw was that talks were stalled. It seems like the only thing that's going to keep happening is that they're going to keep pushing back the deadline until they come to a deal. I mean, what's your outlook on the situation with Greece and the European Union?
Sure. Well, I recently gave 2 examples. The first, it was that in respect to Greece, they're playing Calvin ball. If you remember the comic strip Calvin and Hobbes, the beloved strip, they played a game called Calvin Ball where the rules changed every 4 seconds. And Greece is Calvin Ball because there are no fixed rules. They're just trying to figure out what's going on. Another analogy I've used is that Greece is like Schrodinger's cat. There was a famous physics experiment where you have a cat in a box and it's either alive or dead, and there's a 50-50 chance of either one. Greece is both alive and dead in terms of Eurozone membership, and we don't know which one it's going to be, and we won't until the end. So the situation is a total black box, but it's also fascinating because we have no idea who's going to win and who's going to lose. So, for example, Greece could leave the Eurozone, and things in Greece could actually get better. The drachma could do okay, and then a whole bunch of the Greek money that's spread out among euros right now that left the country could come back into the new currency, and tourism could come back, and Greece could be fine, and then Spain and Italy could be like, whoa, what's this? We want to leave too. And then Greece wins, and Germany is the one who gets just hammered. Or Greece could leave the euro, and like Larry Summers says, he could become a failed state. They could become a failed state and be horrible for Greece. Or they could stay in, and they could have a deal that favors Cyprus. They could have a deal that favors Merkel. It's this really interesting giant poker hand, but it can go in so many directions. All we can kind of do is watch and be amused.
Right, absolutely. It's just like there's new Greek drama unfolding every day, is what it seems.
Right.
Let's talk about a region that isn't getting a ton of news right now. You mentioned that China is getting frightening. What are you looking at over there?
Well, first of all, George Soros, who's a guy who we have deep respect for, and we take a lot of our philosophy from things he pioneered, has said that China basically is a World War III risk. And he wasn't kidding when he said that. And the chain of events that makes China frightening is China is on the verge of potential economic collapse. They've had this huge capital expenditure boom going for years and years that's now coming apart at the seams. And they've also had a massive, massive global real estate bubble that never popped. And the Chinese government has been doing everything to keep that bubble afloat and keep those efforts rolling. And so there was a period where it looked like China was going to let bad creditors take their medicine and things, and then they said, no, we've got to keep propping things up. And so the Chinese government is doing all these things to sort of keep the bubble inflated. But there's new news coming out every day of how they're expanding credit again and doing all these things. But that's just going to lead to an even bigger potential economic collapse when these measures start to fail. And what's scary is the guys in Beijing, it's not a democratic process over there. Those guys do not want to lose power. They want to hold on to power at any cost. And when your economics start going bad, the way to hold on to power is to distract the people by starting some kind of military conflict and stirring up nationalism and patriotism. And if you look at Vladimir Putin in Russia right now, Russia's in the middle of an economic crisis, and Putin's popularity rating is 86%.
Wow.
And so all these Russians are in a horrible place, but they're all cheering Putin, who's doing good things for Mother Russia. And it'd be very easy for China to do the same thing in the Senkaku Islands or something along those lines as a distraction, and that could lead into a conflict that gets pretty ugly. So it's a scary combination of economic risk and an authoritarian political party that does not want to let go of power.
We're on the line with Jack Lytle of Mercenary Trader here discussing the macros. Jack Lytle. I'm sorry, I said title.
Close enough.
I got it partially right. Bringing things here closer to home here. Interest rate sensitive areas of the market are rolling over. Utilities and real estate. You think it's a buying opportunity here? You think the Fed's finally going to make a move on interest rates?
We have our two biggest shorts in the on the equity side right now are in XOU and IYR, the utilities ETF and sort of the real estate ETF. We're short. We think that there could actually be a long way down for these guys, and it's almost independent of what the Federal Reserve's going to do. What's happened is people are realizing, they're finally waking up to the fact that, oh wow, long-term interest rates are going to rise again. And if you look at the long-term bonds, if you look at the U.S. 10-year and 30-year, you see that we've got a potential generational top in, the U.S. bonds went up and interest rates went down for something like 35 years, and now that whole trend may be over. So there's various inflated areas of the market, like utilities in particular, and also real estate investment trusts, that just benefited from this super low interest rate regime forever. And we actually see a lot of downside potential as people realize, hey, even if the Fed holds back a little bit and doesn't raise aggressively, long-term interest rates are going to be going up again. So we don't want to own this stuff. So we're bearish on those areas of the market.
Okay, I'm moving on here. Let's talk a little bit of oil here. And you're looking at the debt-laden frackers can implode if the price of oil drops again. And you also mentioned here the merger and acquisition tailwinds is helping them keep alive. Who are some of those frackers you think that may go bye-bye if you get another drop in oil?
Sure. So Pioneer is one of the most interesting names. I think the symbol is PXD. David Einhorn, the famous founder of Greenlight Capital, came out with a very bearish presentation at Irisone on all the frackers and talked about how their economics are just garbage because they took basically all this free money from the credit bubble and invested it in drilling in wells where the economics don't make sense. And so Einhorn basically argued these guys are prone to collapse, and I think Pioneer was his chief case. And if the price of oil falls again, if we see oil fall back down to, go down to 40 bucks a barrel or something and hit new lows, then we could absolutely see that whole space implode. But the other side of that is the bulls in this area are saying, wait a minute, Pioneer and these other guys are great takeover targets for Exxon and Chevron and these giant oil majors who have to find growth somewhere, and there's a lot of cheap capital out there, so they may just get bought snapped up by larger fish. So you've kind of got you've got these two powerful forces. The economics are terrible, but they might get bought out by the big guys, and I think oil is sort of the swing factor. If we see an aggressive drop in oil again, then we'll start shorting energy stocks, but otherwise we'll avoid either side because they've got a bullish potential takeover tailwind right now.
All right, let's move on to the gold market here. And I was watching that move, I believe it was last week on the Fed day, and they took this thing over 1,200. And I'm like, I just saw no fundamental reason for it, and lo and behold,
Right.
it held there for a couple days. I mean, if we're just hanging out too close to these lows to not to take. I mean, in fact, I think I had a dream the other night that gold went into triple digits. Went into I don't know
You
why.
dreamed about it?
I don't know why. I woke up and I'm like, I got to short gold. I just
Yeah.
woke up and went to the computer and no, just for some reason, 999.99. I mean, and there's a lot of people holding in here. What's your take
Right.
on gold?
Sure. So I would agree with your short-term take. So my take is interesting in that I think that sometime within the next, say, 5 to 10 years, gold could actually do what the bulls think it'll do, and it could go to $5,000 to $10,000 an ounce. But right now, I would rather be short than long because it could very easily go to triple digits first. So if you had to ask me right now which will gold hit first, $6,000 an ounce or 600, I would pick 600. But in the longer term, I would say 6,000. And the reason is because you have all these gold bulls who think, oh, inflation's going to come back and gold's going to do awesome. And they're not necessarily wrong. In fact, they're probably right. But it might take a couple years for that to happen. So, if these central banks unleash an inflationary beast, this T-Rex that stomps all through markets and drives the price of gold up, that might not happen until like 2018, So right now, it's still a deflationary thing. The world is worried about recession and all that, and we would rather be short than long. We don't have a position at all. But I think this is why you're seeing this sort of pinball action in gold. You've got these permanent bulls going, oh, gold could be ready to run now. But it's like, no, it's way too early, so it keeps falling back down again.
Jack, I mean, you're talking a lot of here the fundamentals and the macros, and I mean, you have them
Sure.
down as good as anybody that I've talked to or interviewed on the show. But the macros are good, but how do you pull the trigger on your trades? Is there could you tell us a little bit about your technical analysis techniques?
Sure.
Okay.
Oh, well, yeah, we pay a lot of attention to price. You absolutely have to pay attention to price in macro because there are way too many variables not to. No matter how many pieces of the puzzle you have, you're never going to really get more than 70% of the pieces. And so everything we do is based on odds and probabilities, and we use price to tell us when to take a position, when to increase the size of that position, and so on. One of the things that we tell our research subscribers, we kind of pound the table on this, is we don't actually make predictions. We're more interested in sensing odds and probabilities of things. getting a sense of the odds, and price action helps us do that. So if we see one scenario where the dollar could explode against the yen, and we think this is going to happen, but then we see another scenario where the reverse happens, we may say, well, which one of these is it going to be? And then we look at trend factors, and we see the trend strength of the dollar-yen currency pair, and so price will alert us when to get in and when to get out. So we look at things like moving averages and trends and new high and low points, and then we look at price action in between instruments. What's going on in interest rates can tell us, shape our opinion on gold, things like that. So we very much pay attention to price and technicals, but maybe not in the traditional sense that pure chartists do.
Well, are you a candlestick guy, bar chart, dailies, weeklies? I can't imagine you looking at 1 minute tick charts.
Right. So on my go-to screen, I always have multiple charts. I always on my go-to quote screen, I always have a candlestick chart. I always have a bar chart. I always have a long-term moving averages chart. It's just moving averages, and then I also have a daily, weekly, and actually monthly and quarterly time frames. So when I pull up a commodity or a stock or whatever it is, I can instantly see here's the action for the past couple of days in the candlestick, but then I can also see here's the weekly, here's the monthly, here's the quarterly, so that we try to zoom in and out and get the little picture and the big picture as much as we can all at the same time, because we're looking for big waves to surf. We want the big trends and the big dollars, not the little ripples in a swimming pool.
Okay, let's move on here. You're looking at a trade here. You're looking at the currency. You're talking about the U.S. dollar carry trade unwind, a huge and weighting factor. And you're bullish the dollar versus the yen. Let's talk about that.
Okay. Our favorite trade right now is probably dollar-yen, long U.S. dollar versus the Japanese yen, because there's just the potential for an explosive move there. We made something like 45% in the second half of 2014, mostly from long U.S. dollar positions and short energy. And the U.S. dollar carry trade, we think, is one of the biggest things waiting to happen in the next few years, the unwinding of that. And the U.S. dollar carry trade basically means there's something like $4 to $6 trillion, that's trillion with a T, worth of short U.S. dollar positions that are being held by corporations and emerging market governments and other players who are essentially short the U.S. dollar by having all this U.S. dollar denominated debt. So there's this giant trade out there not being held by traders but by countries and institutions and so on, and they're basically short the dollar. And when that starts to unwind, when we get into risk off and people start getting scared, the dollar is potentially just going to take off like a rocket ship. And meanwhile, with Japan specifically, Japan has been dealing with deflation for something like 25 years now, and they're starting to get really scared. And Abenomics is sort of their last-ditch plan to get them out of deflation. And if Abenomics doesn't take off, if Japan starts to slow down again, which could happen if China slows down because China is their largest trading partner, then their central bank is going to get really scared and they're going to hit the nuclear print button. And at some point there's going to be a tipping point where people lose faith in Japan's ability to have control on its finances. And when that happens, you could see the yen basically turn to confetti. And that will be a tremendous, tremendous opportunity to be long dollar yen. And then this is an example where price follows in. If you look at the chart of USD/JPY, it's just absolutely bullish. It's one of the most massively bullish long-term chart patterns of any instrument out there today. So that's our favorite trade right now.
We've been on the line with Jack Litle of the Mercenary Trader, talking macros, gold, commodities, oil, everything. Jack, a pleasure having you on, and hope we can have you on again soon.
Thanks, Jack.
Thanks. It's been great.